Gareth Soloway, Chief Market Strategist of VerifiedInvesting.com, joins us once more to discuss stocks, Bitcoin, gold, the 10-year yield, Fed monetary policy, the economy, and where markets are headed next. Well, we've had a lot of volatility over the course of the last couple of months, huge decline earlier in the month, and then a big rebound. Most of the losses over the course of the summer have been recovered. Will this momentum continue, or can we expect a big sell-off into fall following the Fed pivot? We'll discuss this with Gareth today. We'll find out. Gareth, welcome back. Thanks for being here.
Hey, thank you, David. Always great to be back. We have great conversations.
Great conversations, great momentum in the markets today. The Dow rallied 100 points. 3 weeks ago, the NASDAQ was down about the same amount. And we were really, well, the markets were really frightened. As you recall, just 3 weeks ago, the VIX rallied to 60, which has not been seen since 2020. It's been speculated that the reversal of the yen carry trade was one of the causes of that sell-off. But anyway, it seems like things have rebounded since then. What do you make of this pattern? Is it repeating anything? Does it look like it's doing something that we've seen before, or is this completely new territory, what the market is doing right now?
Yeah, and this is really where things get interesting, right? So if we take a look at the S&P 500, what I've noticed, and I was doing a lot of research this past weekend, is that the S&P 500 appears to be repeating the exact pattern we saw in 2007. And again, patterns tend to repeat because investor psychology doesn't change. That's why technical analysis works, is because a bear flag 20 years ago, 40 years ago was created by investors feeling a certain way. There were buyers, there were sellers, and it creates that same sort of formation. So if we look at this, check this out, guys. So here's your current S&P 500, and it's so eerily similar. So what we saw was this initial move up, and we can see this was the big bull market leading up to '07, right? And or I should say in 2023, 2024 here, and we saw this 6% drop, a low put in. We then saw this big move up, right, to the latest all-time high, a 10% drop with a higher low, and then we've shot back up. So if we go over to 2007, we saw the same sort of thing. Bull run, 6% drop, exactly 6%. So, I mean, this drop exactly to this drop. We had a low put in, a big bull run, and then an 11% drop back in '07 to a higher low, and then we shot up just like we did. All right, so now the kicker is, if this is playing out the same way, this tells us that the S&P may make a new all-time high, which from a psychological standpoint would decimate the bulls, right? I mean, think about the heartbreak after a 10% drop that the bears would feel. So it would decimate the bears. It would get the bulls even more emboldened. The media would go nuts. And then what we saw in '07 into '08, '09 was obviously the big collapse, the 66% drop. So the idea here is, and this is fascinating, is that we might go up a little bit more, make a new high just to flip people out. And then you see that bigger move to the downside like this. And needless to say, it doesn't go straight down, but it could definitely have a much bigger corrective move to it. So again, listen, there's nothing that says this has to happen. But as an investor, as a trader, as a technician, I have to be aware that human psychology repeats. Greed is greed, fear is fear. 100 years ago, 1,000 years ago, it was still like this. So we have to watch this pattern formation.
Well, it's important to know that this formation has happened several times since 2007. But what makes this time, I guess, similar to 2007 is that the Fed is about to pivot. You'll recall that the Fed back then in 2007, they kept rates unchanged all the way till September 2007. And then they started dropping rates actually before the Lehman collapse later in 2008. And so
That's right.
they probably had telegraphed a recession or some sort of slowdown, kind of like what they're doing now. Jerome Powell has made it pretty clear in his last press conferences and in the meeting minutes from July that he thinks the labor market is cooling. He used the word cooling. Yeah, let's talk about monetary policy and what we can expect the markets to do after a Fed pivot in September. What do you think is going to happen, Gareth?
So just like you mentioned, I think it's important for investors to recognize that historically, when the Fed actually starts cutting rates, that's when markets tend to roll over. The reason that happens is because almost always the Fed is looked at as being too late to the punch, right? They start cutting, but they're not cutting fast enough for what the market wants. So we'll see what they do in September. There's going to be a rate cut. The question is it 25 basis points? Is it 50? How do they guide the rest of the year? One thing I would point out is, number one, the dollar has broken down. So if we look at the DXY chart here, there was a classic wedge pattern, and the dollar has now broken this. And what this tells me is the dollar is going a lot lower, which means the economy is likely going to get much weaker than we expect, forcing the Fed to cut even more. Because the more the Fed cuts, the weaker the dollar in general gets, especially against a basket of other currencies like it is. So that's number one. And we can also see that the 10-year yield has also had a big breakdown here and is likely headed to a major target range of 3.3 to 3.2%. So you can see trend line right through these lows. And then this one's a beauty, upsloping, and both of these lines meet. So this tells us that yields are going to go lower. The only reason yields are going to go lower is if the Fed has to cut quite a bit. Now, the market, you would say, well, wouldn't the market love that? Well, the market would love that if the Fed was doing it for other reasons than the economy was collapsing. And I would just like to point this out. We were just discussing this before we went live, was that the Fed was unbelievably dovish. Their minutes last week that came out, they talked about a July rate cut. That was surprising to me. Then Jerome Powell at Jackson Hole, he was unbelievably dovish, saying the time has come. We're going to cut multiple times. What struck me, and the markets rallied, right? On Jackson Hole, we saw Friday, the markets were up. But what struck me was that he was so dovish, and the other members are already talking about rate cuts that could have happened at July. What are they hiding? What are they not telling us that they're seeing? Because if you look at the jobs numbers, I mean, yeah, we're weakening, but is it really weak enough to denote a rate cut in July potentially that they didn't do, but they talked about it seriously, and all of these coming up? So I would just throw this out to investors, is be really careful. This is telling me the way the Fed is talking is that they see data that is concerning them, whether it's in the financial system or in the economy, that is making them say, we got to cut, and we got to cut quite a bit over the next few months.
Before we continue with the video, I'd like to take a minute to talk about investing during volatility. Now, in today's volatile economy, protecting your wealth is paramount. Gold has always been seen as a trusted safeguard, but what is another low-risk way to be exposed to gold? How can you maximize returns while potentially minimizing risk? Well, the answer lies in gold royalty companies like Metalla Royalty and Streaming. Metalla has one of the highest royalty growth portfolios in the market, offering exposure to gold and the clean energy transition through their strategic copper royalties. This makes Metalla a dual investment in the future. By investing in Metalla, you gain the upside of gold and copper mining without operational risks. Their expert team has curated a diverse portfolio of over 100 royalties, minimizing risk and maximizing potential returns. Don't let inflation erode your wealth. Consider Metalla today to secure your financial future with the power of gold and copper royalties. Watch my full interview with CEO Brett Heath on inflation, Fed policy, and mining by clicking on the link in the video description down below. Well, yes, bad data probably portends a Fed cut, but wouldn't a Fed cut generally be bullish for stocks if interest rates go down, your discount rate goes down, valuations go up? I mean, that's one way to look at it. Is that going to happen this time, do you think?
So historically, when you get these downturns, right, I think about when the Fed was cutting rates in '08, right? The markets did not rally in '08. We know it had a massive move down.
Yeah.
You could go to almost any other period where the Fed was cutting rates aggressively. And the reason they're cutting rates aggressively is not because, the economy is still good and all. Because keep in mind, if they cut rates too much and pump too much money into the system, what's going to happen? Inflation's going to roar back. So the only reason they're going to cut rates is if inflation is under wraps, deflation potentially, which could be on the cusp, meaning that we are in a major recession on the horizon. So I would dare say that the cuts, if the Fed is going to cut aggressively, it's telling us the economy is in shambles. And that, again, is not good for stocks because you have the consumer, which, by the way, we've already seen the consumer struggling with many earnings reports from companies saying this. And if the consumer continues to struggle, it means earnings essentially come down quite substantially.
Okay. I want to touch on that in just a bit. So let me just show my screen very quickly. So to your point about the Federal Reserve cutting into a recession, that's what's happened in the past, just for the audience to be aware of. This is the Federal Reserve Fed funds rate going all the way back to 1955. So you can see in 2007, we talked about cutting into a recession. 2020 was an anomaly because of the pandemic, but anyway, that happened as well. 2001, same thing. We had 1991, same thing. It didn't happen in the mid 80s. We skipped that. However, early 80s, same thing. 1975, 1971, 1960, 1957. So
Wait,
in most cases, whenever the Fed pivots, we get a recession shortly right after. So
yeah, and I think that's so important for viewers to understand is because most people think, oh, easy money's coming back. They're going to flood the system so stocks can go to new all-time highs. But historically, when they do this, as you just showed there, you can see the recession comes on right after. And if you were to overlap the stock market during that recessionary period, the stock market initially has a relatively big drop. We saw it in 08, 09, but then interest rates staying so low as we emerge out of it, then that's when the big move up comes back in the stock market.
the question is, I mean, the market is a group of smart people making decisions on where things are going. If they're seeing the same data that we are, stocks are still going up. They're not too concerned about what's going to happen.
Right.
Why do you think that
No,
is?
that's a great point. And one thing I would point out is that so number one, we've had this monster reflex bounce in the stock market from the recent 10% correction in the S&P 500 to the point where we're almost back to all-time highs. But what I would point out is that the volume over the last couple of weeks has been late August, characteristic, insanely light volume, which is mostly just retail investors. So retail investors, they've been conditioned by the Fed to buy the dip, no matter what, buy every dip. They're doing that, assuming we're going back to all-time highs. There's funds that have to play catch-up too, which is a little bit of it. But that volume, when you don't see big volume in the stock market, it's telling you the big money is sitting on the sidelines. Now, a lot of them are on vacation right now. We'll see in September what happens once they come back. But it's certainly this rise has not been a majority of big money. It's been more the smaller investor piling in, chasing the NVIDIA collapse, thinking AI is going to take over the world, and so on and so forth.
So, what are the indicators that we need to look for before we can conclude this momentum is waning?
Yeah, so I think you want to look at things like some of these big names, right? So you want to bring up an Nvidia, and I'll show my chart again so we can kind of take a look.
Yeah.
But really something like Nvidia, which by the way today is actually taking a little bit of a hit. Nvidia, you have a high, a lower high, and still a lower high. So obviously Wednesday we have the earnings after the bell on Nvidia. This is going to be so pivotal for the market because if Nvidia can't make a new short-term higher high and it stalls out at this beautiful parallel channel, look at the high here, right through here, this low pivot, the low pivot here and hammering here. If we can't make a new high on Nvidia, then I think you have to say, okay, the market's in trouble. Nvidia, the semis have rocked and carried the market. We've seen so much concentration of wealth going into these stocks. At some point, there could be that unwind, which we kind of saw over the last month or so. But now we're right back to this over kind of abundance of investors in these stocks. So something like this is important. I think you look at the tea leaves, right? The dollar breaking down. What's that telling us about the economy and what the Fed is going to do? The 10-year yield coming in is, what are the earnings numbers saying? What are the consumer doing? Housing prices. I mean, housing inventory is starting to pop up. So a lot of these things are pre-recession indicators, and they're just popping up left and right.
Well, let's take a look at the tech sector overall. If you just pull up a NASDAQ chart, Gareth, and I want to do something real quick. If you overlay the NASDAQ with Bitcoin, which we'll talk about in just a bit, the Bitcoin chart and the NASDAQ charts, these two series have overlaid each other quite well in the past, and that correlation seems to have broken down several times during the summer. What's going on here?
Yeah, and you can see it right down here. We have the Nasdaq, which again has continued to go up a little bit, but the Bitcoin chart has much more kind of chopped sideways to lower.
Yeah.
And again, what I think is going on here is that the money being pulled out. A lot of this is so you have the highest risk in the market, which is crypto, right? And so there are investors that are saying, "Hey, listen, we're getting nervous about the market. We're getting nervous about risk assets." We think that NVIDIA and these stocks, these mega cap tech stocks, are still the place to be. So money, I think, is rotating over, and you're seeing Bitcoin suffer. We didn't see. Now, listen. One thing I will say is Bitcoin bottomed out recently at around 49,000, the same day as the August 5th low on the stock market. So there is still some correlation, but there's no doubt that we've broken down on that. And I think it's because the stock market has performed so well, it's sucking up so much of that money that would go otherwise into crypto.
Okay, so let's take a look at Bitcoin then. Like we said just now, Bitcoin has diverged somewhat from the NASDAQ over the last couple of months. It's kind of just moving on its own. Well, not really on its own, Gareth. I've noticed it's been more correlated with the Russell 2000. So if you strip
Yep.
away the biggest tech names like Nvidia, and you just look at the mid caps or small caps, Bitcoin tends to follow that market a bit more. But generally, this pattern. What do you how do you interpret this? We've seen lower highs, lower lows ever since the beginning of the year.
Yeah, so one of the things I think is fascinating is that when we had that big dump on August 5th, which again was when the Nasdaq was down over 5% early in the day, we actually touched on Bitcoin, the spot ETF approval high before we had that 20% correction in Bitcoin, right? So we actually retested a technical support level. It was resistance. We broke out above it. We've now come back and retested it. In addition, you have this parallel channel, right? So this parallel channel, when you have a big move up like this is actually what we would refer to in technical analysis as bullish consolidation. Basically, price makes lower highs and lower lows, but it stays within the up move, which was from this low here all the way up to 74,000. And so actually, as long as you stay within this parallel channel on a closing basis, this is actually a bullish chart for Bitcoin. And it does make me wonder if the stock market starts getting weaker and investors start to say, hey, listen, maybe we don't want to be in the stock market quite as much. Does Bitcoin see money flow? Because as you mentioned, it has become uncorrelated. Maybe money was flowing out of crypto and Bitcoin into the stock market. Maybe it reverses a little bit. And so I would actually be, as long as this parallel channel holds, I would be bullish on Bitcoin here.
Really? Okay. What's the upside target you see for Bitcoin in the short term?
So you got to respect the channel. So 69,000 right up here. Again, what I do as a technician is I look at the history of it, and we can see every time it hits this line, it pulls back. So at least in the short term, if you hit 69, see if it pulls back. If it can break through that, 74,000 is a minor stopping point, which would be the all-time high. And I think you actually go quite a bit higher than that. I would even dare say that it wouldn't shock me in the next year or two. And I know Bitcoiners would love to hear sooner, but I do think 100,000 is definitely on the radar for this asset. I do think it slowly is becoming a risk asset here, essentially it's becoming a asset that is not as correlated to the stock market as more so gold. I would say more so gold.
Downside risks, Gareth. We always have to be aware of the downside. So this orange line that you drew, this support line, can we say that if it touches, let's say, below 52,000, then we're entering a new bear market, or it's going to have an even further decline?
Yeah, and I'm glad you brought up the downside because investors have to be aware that there is downside risk here, right? So if the markets, and this is something we saw, so we look at this dump on Bitcoin that took us from 70,000 down to 49,000. First of all, that's a massive drop in basically 2 weeks. So investors have to understand that if you do break below and have a daily close below this level here, this parallel channel, it does open the door to seeing some major downside. And if we took out 49,000, I would start to say, okay, well, your next stop would be your 20% low correction from the spot ETF at 38,000, 39,000 area. So again, just understand that Bitcoin seems to have a little bit of this gold sense where it does better when the stock market struggles a little bit, but it also still can get panicked. Investors can get panicked and still dump it out when there's all out panic, as we saw. And by the way, gold sold off that same day as well when we saw the stock market and Bitcoin collapsing. So when panic hits, all assets get sold. People ask questions later, they just dump it at that point. So I would be very aware of that. And again, this is where technicals come in, is that if you do see a break of this area, you just step aside, let the dust settle, and then reevaluate. You might be able to get it at a lot lower level.
Well, can you just talk about these bullish indicators for Bitcoin one more time? Because like I said, when we first started talking about Bitcoin, if you draw a multi-month trend line all the way back to the beginning of the year, it looks like Bitcoin is just consolidating in this slightly downward momentum, this weak market phasing downward. I wouldn't call it particularly bearish. I wouldn't call it a particularly dramatic bear market, but it's just been going down over the course of the last year. So why are we seeing bullish indicators? Can you tell us about that?
Yeah, absolutely. So what in technical analysis, when you have a sharp up move like this on the chart, and then you kind of go into this period, what's happening is that it's had a big run. What happens is psychologically, some investors say, wow, it's gone up so much. I'm a little nervous about Bitcoin. Maybe I'm not a hodler out there. So you have some sellers that come in, right? But when you have, if it was only sellers, price would collapse back down. But even at the current level of between 50 and 70,000, we're seeing buyers coming out of the woodwork and meeting them here, right? So
Mm.
even though you had this huge run in Bitcoin up here, yeah, there's some sellers, there's sellers coming out, but there's also buyers stepping up. And that creates this kind of equilibrium of buyers and sellers, which again, after a bull run is really impressive because you're not getting just all sellers like, oh, let's just take the money and run. There's still buyers that are willing to step up. Now, eventually, as the buyers are willing to step up, eventually the sellers get exhausted of selling. There's all the people that want to sell, they sold, right? So what happens then is if buyers are still willing to step up and eventually the sellers that wanted to dump, what do we get? We get the breakout up to the upside. And that's where you get that next leg to the upside. So that is a bull. If you're a bull, that's what you're looking for on Bitcoin, is that those sellers finally say, okay, I've unloaded what I wanted to. There's no more sellers. And because the buyers have held price so close to the highs, it then gets its next bull run. And once it breaks the highs, all new buyers come in. They start chasing to the upside.
Okay, I'm just gonna flip to my screen real quick. This is an
Yep.
article from money.com. It says here, looking ahead, seasonality is not in favor of the asset class, as September has tended to be a terrible month for Bitcoin and Ethereum, analysts say. So the September is known for being a bad month for the stock market, but also risk assets overall. Do crypto prices rise or fall in September? That is a question they're posing. That is a question I'll ask you. And of course, this September is different because this September, and like prior Septembers, we're getting a Fed pivot. So, what do you think is going to happen? Yeah.
And so you're right about that. So September happens to be a really poor month for the stock market, for Bitcoin, because it's generally been correlated with the stock market and risk assets. But again, the beauty of it is that just because something tends to be a bad month, it doesn't mean it is going to be a bad month. And I think the important thing for us as technicians is that who cares whether it's a bad month or a good month? Let's just let the chart tell us, right? So,
Hmm.
if Bitcoin comes down here, it's still okay. If Bitcoin starts getting in this lower range and having closes below 53,000, then you have to step aside as an investor and say, okay, if it breaks down here, you're going to see a much bigger flush. But again, for me as a trader, I don't want to kind of say, oh, well, September's a really bad month, so I'm going to assume it's going to be a bad month. It's more like watch the levels. And if the level breaks, then yes, the technical support has broken and price can fall through. But until that happens, I have to go with what the chart is telling me. Funny thing. I've traded off charts a long time, but I trade off every once in a while, especially in my early years, I traded off emotion. And I kind of said, oh, well, September's a bad month, so let me go short. Almost every time I'm wrong. When I go with my gut or my brain or my heart, I'm wrong. When I focus on the charts, the probabilities are that I'll be right more often than not.
Okay. All right. Well, let's not trade with your heart. Let's use our brains, Gareth. We've done this
Yeah.
session many times before on how to trade. People can check out prior episodes in the past. So, Gareth, okay, what level would you be comfortable buying Bitcoin? Would it be lower than here? Would now be okay?
Yeah, so what I'd look for is I'd look for anything below 61,000. So 61,000 is your pivot line. I think we'll
Okay.
probably come in and test that. And then you kind of accumulate between 61 and 53 and then you use a stop. I would for me probably use a stop any daily close below 49. You exit immediately. And so ultimately you run the risk of 10 to 20% downside with the upside to 74, which gives you good upside, 20% upside, maybe even letting some run towards that 100K marker. But again, as a trader, like I think this is the big differential is that there's so many investors out there that they're just like, I'm just going to go in and let it do its thing. Much more I'm as a trader where it's like, listen, if it holds this range, then it's good. We're
Mhm.
fine. If it breaks it, then I got to stop out. I got to take a loss. I'll take a small loss. I'll regroup and I'll look to buy it lower at a much better price once the chart tells me that's doing it. But right now, the chart still remains bullish.
Okay. Well, let's talk about gold. Gold has had a great year, 25, 148 is the latest price that I'm looking at for the spot price. And it's recently broken new all-time highs about a week and a half ago. And it's just, yeah, it's on a tear. The weak dollar may have something to do with it, but I'll let you do the analysis. Why has gold been going up, and ultimately, what can we expect for the remainder of the year?
Yeah, so the dollar breakdown has been a key influential part of this. It's a safety asset. We know central banks, and this is something, by the way, if people want to go back and watch our interviews in late December of last year, early January,
Hmm.
one of my targets was 2,500 on gold. I did say it would be the best performing asset. I think Bitcoin still has it beaten for now. We'll see if that's the case, but I think gold has outperformed the S&P at this point for the year. But the key here is that ultimately the upside has come through. The dollar has weakened. The Fed has gotten closer to cutting rates. The central banks have been buying gold hand over fist, which always is a great indicator, right? These are the guys that print the money. So chances are, if they're buying gold, we all have to be following them. And I think also you look at like the price action here, and it's very emblematic of the market and investors saying we don't trust a U.S. debt that just keeps going up, even in an expansionary period, right? And not to get off track here, but with 35 trillion in debt at the U.S. government level, we know that essentially, generally, debts are supposed to be paid down during expansions. And then during recessions, the government comes out and spends more and runs up debt. Well, it's been the opposite, and it's only going to get worse if we do go into a recession. The government will spend more, the Fed will loosen monetary policy, and that's very bullish for gold. So again, any asset, palladium, platinum, I like them all, as long as they're precious in that sense, they're relatively rare, and I think gold goes ultimately higher. I mean, I still expect pullbacks on gold, but I think you buy the pullbacks at this point. In fact, I'll show you guys my next upside target. On gold here. And that upside target is you found by going to the logarithmic chart on gold. And if we zoom out, this is pretty remarkable here, guys. We're going to zoom out all the way to the 1970s, and we're going to take the high from 1979. We're going to connect it through the high from 2011. And what this tells us is we should see upside to somewhere around 2675, 2660. That should be our next target. Now, I'm not going to say by year end. That's a little too, I've already hit my year end target, so I'm going to rest on those laurels. But ultimately, by early 2025, I do think we're at 2660 on gold.
Okay. Well, are you seeing any overbought technical indicators on gold currently?
Yeah, there are. I mean, there are, in all fairness. I mean, we could just pop up. Let me flip back to my regular chart so we get rid of the logarithmic here. But yeah, if you just go to things like relative strength index, there's no doubt that we're kind of in the upper range here. Relative strength index above 70 tells you you're overbought. There's also a negative divergence here. So to me, this is one of the reasons why with my swing traders in my commodity service, I've unloaded our gold position, because in the short term as swing traders, I do think it's going to pull back. So for those of you that don't understand positive or negative divergence, just to give you guys an awesome educational crash course, when price goes up, RSI should be going up, right? When RSI has a high and a lower high, but price has a high and a higher high, that's called a negative divergence. That means price is beginning to get weak for the chart in question, in this case, gold. And so my guess is gold does have a pullback coming. And if we go back to the daily chart, the pullback for me would simply be to the lower end of the parallel channel here. If we put this in and we drag this down, it would basically be back to about 2350. So a pullback to 2350, I would buy though.
By the way, let's talk about RSI for just a bit. How do you read RSI? I've heard the viewpoint. This came from Jack Schweiger, actually, the Market Wizards author. He said that when RSI goes above 70, the conventional wisdom tells you it's overbought, you should sell, and vice versa for 30, oversold, buy. However, he's observed in the past that whenever these momentum indicators, what the RSI reaches 70, you should continue buying because momentum will stay for a bit longer. Ditto for when it goes down to 30. Don't buy yet. It might sell down some more. What do you think of that?
Yeah, I agree with that. So in general, just because an RSI is over 70 does not mean go short or sell. And just like below 30, it doesn't mean buy. Things can remain overbought and oversold for long periods of time. But what you do look for is these divergences. The divergences generally are good indicators. And again, that would be something like we just looked at before, where you start to have these negative divergences. So it's where you get the divergences that's when price is more important. And by the way, in 2021, you saw a great negative divergence on Bitcoin when it was making that higher high of 69,000 with the 65 prior from April. There was negative divergences there. But again, only once you see the negative divergences do you then start to say, okay, maybe I start nibbling on the short side or on the long side based on where it is.
Okay. So ultimately, then, Gareth, what are your which assets are you most bullish on for the remainder of the year?
Yeah, so I think on pullbacks you buy gold. I think for the most part now, most of my portfolio is now angled towards the short side. When we dumped out on August 5th, I was going crazy buying. I mean, some of these stocks that got crushed were just amazing opportunities, like even Nvidia when we were down at those lows. But for the most part, I would stick to gold. I would stick to select individual plays like there are a few plays out there that kind of intrigue me with high risk. Walgreens, and again, this is not an asset, but it's a stock individually. But when interest rates come down, a company like Walgreens should do better. They have a lot of debt. Small caps in general would do better. But just to be fair with the crowd out there watching, I'm a majority on the short side, even though I expect maybe a potential slight new all-time high before a bigger rollover in the stock market.
Okay. And bearish assets, stock markets, I'm guessing, Bitcoin. Well,
Yeah.
Bitcoin, you said you're bullish on, so no.
Yeah. So, well, yeah. And now listen. I'm not in Bitcoin right now on a swing
Okay.
trade basis. I am bullish net, but I have to see a pullback to be a buyer. But as long as that channel holds on Bitcoin, then I would be a buyer. If it breaks, I stop right out. And then if you look at things like this, and I just want to show this, by the way. So here, you guys want to see something cool here. So here you had a high and a higher high on the Qs. And look, you had a high and a lower high on the RSI, even though price was higher. And then remember what happened. We saw that big dip. So things like that, this negative divergence showed up right here on the Qs just before that big drop. Now, this is, by the way, the RSI isn't an end all be all. It's not like it always works. It's all probability based, and you obviously have to use stops and maneuvering to kind of be in the right position. But yes, for sure, I have puts on the Qs right now that are long dated out 2 years. And again, I'm doing that to give myself lots of breathing room, but I have a large put position on the NASDAQ 100. And I have things like QID, SDS, which are inverse ETFs, short the S&P and the NASDAQ.
Okay. Gareth, thanks very much. Where can we follow you and Verified Investing?
Yeah, just come to verifiedinvesting.com, guys. There's so much good quality stuff on that website. That data center homepage has so much on there. Just check it out. It's all free there. There's obviously services like my commodities, my crypto, and my stocks and ETF services. But just even enjoy the free content and the free quality information that we have on that data center. It's really insightful. And as always, David, we have such great conversations. Thank you so much.
Yeah, we always appreciate you and your analysis, and we appreciate you coming back on the show to educate us. Let's wait for more volatility. Let's see what happens in a couple of weeks when the Fed cuts. We haven't talked about inflation, but inflation numbers will come out, so we'll talk about that next month. Thanks very much, Gareth. We'll speak again soon.
Thank you.
Thank you for watching. Don't forget to like and subscribe and follow Gareth in the links down below.